On the morning of February 25, 2026, the opening bell did not wait for Driven Brands. The stock had closed the day before at $16.61. Within minutes of trading, it opened at $9.99, a drop of nearly 40% before a single mechanic had turned a wrench. But nothing had changed on the ground overnight. The bays at Take 5 oil change were still full. The paint booths at Maaco were still running. Franchise royalty checks were still clearing the same way they had the week before. The panic on the trading floor was not a reaction to a broken business. It was a reaction to broken numbers the company itself had built, filed, and defended for years. By the closing bell that Wednesday, the stock had clawed back some ground, settling near $11.60, a decline closer to 30% from where it had started. The swing inside a single day, nearly 10 points of difference between the morning low and the afternoon close, was its own kind of evidence. It showed a market trying to price something it could not yet measure. How much of the last 3 years of Driven Brands' reported earnings had ever actually existed? This was not the story of a company caught stealing from customers. It was the story of a company that, according to its own audit committee, could no longer vouch for its own arithmetic. Driven Brands built its business on convenience: the 10-minute oil change, the walk-in windshield repair, the neighborhood body shop that never closed on Saturday. Under one holding company sat Take 5 oil change, Maaco, CarStar, and a national auto glass operation, along with several smaller regional brands. Each location sent a slice of revenue upstream, and that slice, franchise fees, royalty payments, service revenue from company-run stores, became the raw material for something more complex than any single garage. A financial structure known as a whole business securitization, where the cash flow of thousands of storefronts backed hundreds of millions of dollars in bonds sold to institutional investors. That structure depended on one thing above all: trust in the numbers. Bondholders, lenders, and public shareholders alike needed to believe that revenue reported each quarter reflected revenue actually earned, that cash on the balance sheet was cash that actually existed, and that leases, fixed assets, and tax provisions had been counted the way accounting rules required. The company had wobbled before. In October of 2022, Driven Brands disclosed delays integrating its national auto glass business and weaker-than-expected car wash performance, and the stock fell more than 7% in a single session. By August of 2023, the company admitted its glass integration was running several quarters behind schedule, and the stock dropped more than 40% on disappointing earnings. Shareholders sued, alleging the company had overstated how well the glass acquisition and car wash retention were going. That case covered investors who bought stock between late October of 2021 and early August of 2023, and it ended in a $25 million settlement, approved by a federal judge in June of 2026. Both the company and its former chief executive and former chief financial officer denied any wrongdoing as part of that resolution, agreeing to settle rather than continue litigating. That episode looked, at the time, like a growing pains story, an ambitious roll-up stretching to integrate acquisitions faster than its systems could track them. Nobody yet knew that inside the accounting itself, a much older and much larger problem had been sitting on the books, unexamined, since 2023. The problem, once found, traced back further than anyone outside the company had suspected. An unreconciled cash balance had originated in fiscal year 2023 and simply stayed on the books, uncorrected, for years. Around that single discrepancy, additional errors accumulated: lease accounting entries that misstated right-of-use assets and liabilities, expense entries that shifted supply costs into the operating expenses of company-run stores, misclassified fixed assets, mishandled cloud computing costs, an incorrectly calculated income tax provision, and revenue recognized before it had actually been earned inside the auto glass business, concentrated mainly in fiscal year 2025. Reporting on the disclosure initially described 7 categories of material error. Later filings and the shareholder lawsuit that followed referred to 10. The discrepancy between those 2 counts was never fully resolved in public reporting, but the direction was consistent. The number of things wrong with the books kept growing the deeper the review went, not shrinking. None of this required a single dramatic act of theft. It required something quieter: cash that never got reconciled, leases that never got recalculated, revenue that got logged a quarter or 2 before it should have been. Each entry on its own might have passed as a rounding error. Stacked together across fiscal years 2023, 2024, and 3/4 of 2025, they inflated revenue, inflated cash, and understated operating expenses across 2 full fiscal years, and every quarterly filing in between. Behind the numbers sat people whose job was to catch exactly this kind of drift before it reached investors. A chief accounting officer signed off on the filings for 2023 and 2024. A chief financial officer who joined in August of 2024 inherited a set of books already carrying the unreconciled cash balance. Every quarter, the machinery of public reporting rolled forward, each new filing built on top of the last. None of it questioned publicly, until the review that began in early 2026 finally forced the issue into the open. The turning point arrived on February 25, 2026, though the work behind it had clearly been underway for some time. Driven Brands Audit Committee announced its conclusion. The consolidated financial statements for fiscal years 2023 and 2024, along with the interim results for the quarters ending in March, June, and September of 2025, contained material errors and could no longer be relied upon. All of them would need to be restated. The company said management had identified material weaknesses in internal control over financial reporting, and concluded that both internal controls and disclosure controls were not effective as of the close of fiscal year 2025, on December 27th of that year. In plain terms, the systems built to catch exactly this kind of error had failed to catch it, for years, across multiple reporting periods. The practical fallout came fast. Driven Brands said it expected to seek a short, 15-day extension to file its annual report, because the restated numbers were not ready. It postponed its fourth-quarter financial results and canceled the investor conference call that had been scheduled for that same morning. And in language that unsettled analysts more than the disclosure itself, the company warned that its review was still ongoing and that it might identify additional material errors before the process was finished. It was not presenting a fixed, corrected number. It was presenting an admission that the correct number was still unknown. The market's reaction split into 2 distinct movements. At the open, the stock collapsed from $16.61 to $9.99, a decline of nearly 40% in the first minutes of trading. Over the course of the day, some of that reaction eased. By the closing bell, shares stood near $11.60, a decline closer to 30% from the prior close. The gap between those 2 numbers reflected a market trying to separate what it knew from what it feared. What it knew was that 3 fiscal years of filings were now unreliable. What it feared was that the review was not finished. Within weeks, a shareholder class action was filed in the Southern District of New York, naming Driven Brands and 5 executives, alleging investors had been misled through materially false statements and omissions about the company's financial performance and internal controls across a class period running from May 9, 2023, to February 24, 2026. Nearly 3 years of public filings now under legal challenge. The named executives included Jonathan Fitzpatrick, chief executive until May of 2025, and now the board's non-executive chair. Michael Diamond, chief financial officer since August of 2024. Michael Beland, the former chief accounting officer who had signed the filings covering 2023 and 2024. And Daniel Rivera, chief operating officer until May of 2025, and now president and chief executive, who the complaint alleges had certified, alongside another officer, that the company's disclosure controls were designed effectively, a certification made in November of 2025, just months before the admission that those controls had not been effective at all. None of the allegations in that complaint had been resolved by a court at the time these facts were compiled. Every named individual remained, legally, an accused party, not a convicted one. The stakes behind those filings were not abstract. By the middle of that year, Driven Brands carried total debt of $1.69 billion, and after subtracting roughly $184 million in cash on hand, net debt stood near $1.5 billion, nearly all of it structured through the whole business securitization built on franchise cash flow. Slides released in August of 2026, reconciling reported net income with the earnings figure used to calculate debt covenants, showed an adjustment gap of more than $325 million, a distance that, on its own, illustrated just how far reported profit had drifted from the number lenders actually relied on to judge the company's health. In the months that followed, the costs of the collapse became measurable in ways the earlier scandal never had been. Management estimated between $35 million and $45 million in one-time expenses tied directly to the restatement and the remediation of internal controls in 2026. Money spent not on growth, not on new locations, but on rebuilding confidence in numbers the company had already reported once. The restatement itself was eventually completed. Driven Brands finished reworking its financial statements for fiscal years 2023 and 2024, along with the corresponding interim periods, closing the loop the audit committee had opened in February. Alongside that, the company restructured how it reported its business altogether, moving to 3 segments. Take 5, franchise brands, covering Maaco, CarStar, and the smaller Radiator and specialty brands, and Auto Glass Now, after selling off its international car wash operations entirely. The business that emerged looked smaller and simpler than the one that had triggered the crisis, and that simplicity was, in part, the point. The deleveraging that followed was aggressive by any standard. Over the course of 2025, the company paid down $545 million of debt, pulling net leverage down to 3.7 times earnings by year's end. After the January sale of the international car wash business and additional payments of roughly $470 million, pro forma net leverage settled near 3.3 times, with the entire debt load securitized at a weighted average fixed rate of 4.3%. Part of that process included retiring $275 million of one note series outright and prepaying $80 million of another ahead of schedule. By August of 2026, the leverage ratio measured 3.1 times, just above management's own year-end target of 3 times, and a marked improvement from where the company had stood when the crisis broke. None of that repair touched the older case. The 2021 to 2023 lawsuit over the glass integration and car wash retention had already been resolved on its own timeline, separate from the accounting crisis that followed it. That settlement, $25 million, covering investors who bought shares between late October of 2021 and early August of 2023, received final approval from a federal judge in June of 2026, 4 months after the new accounting scandal broke. Fitzpatrick and former Chief Financial Officer Tiffany Mason were both named in that earlier case. Both denied any wrongdoing, and the settlement was structured, as most securities settlements are, to end costly litigation rather than to establish guilt. Underneath the executive turnover and the legal filings, the franchise machinery itself kept functioning without interruption. Royalty payments from thousands of independently owned Take 5, Maaco, and CarStar locations continued flowing upward on the same schedule they always had. The securitization structure, backed by those franchise cash flows rather than by corporate earnings directly, meant that bondholders were shielded in large part from the accounting chaos happening several layers above the storefronts that generated the actual cash. That separation between the operating reality of thousands of small businesses and the reported reality inside a single holding company's ledgers was, in the end, the clearest explanation for why the stock could fall by nearly 40% in the morning and recover a third of that loss by the afternoon. Investors were not repricing garages. They were repricing trust in a spreadsheet. What remained unresolved at the time these facts were compiled was the newer and larger case, the one built on 7 or 10 categories of material error, on years of unreconciled cash, on internal controls that failed quietly until an audit committee forced the failure into daylight. That case named a sitting board chair, a sitting chief executive, a sitting chief financial officer, and 2 former accounting officers. It remained, in full, a set of allegations. No court had ruled on the merits. No verdict had been reached. The Driven Brands collapse offers a distinction worth sitting with. The difference between a business failing and a set of numbers failing. The oil changes never stopped. The paint booths never went dark. The franchise fees never missed a payment cycle. What failed was the internal machinery meant to translate thousands of small, real transactions into a handful of large, reported figures. And that machinery failed not once, but across 7 or 10 separate categories, compounding quietly for close to 3 years before anyone outside the company noticed. That is the part of the story easiest to overlook once the stock price recovers or the restatement gets filed. Internal controls exist precisely so that an unreconciled cash balance from 2023 does not still sit on the books, unexamined, in 2025. Certifications exist precisely so that officers put their names behind a claim that those controls work. When a company later admits the controls were not effective at the very moment officers had certified that they were, the gap between the certification and the reality becomes, by itself, the subject of the shareholder lawsuit that follows, regardless of what a court eventually decides about intent or blame. It is also worth noting what did not fail. The whole business securitization structure, built on the unglamorous cash flow of oil change bays and body shops, kept servicing its debt and kept its bondholders largely insulated, even as equity investors absorbed the shock. The deleveraging that followed, hundreds of millions of dollars paid down, a leverage ratio brought back near management's own target, showed that the underlying franchise economics were never the thing in question. The question was never whether people wanted their brakes fixed or their windshields replaced. The question was whether the company counting the money from those repairs had counted it correctly. Every executive named in the 2026 lawsuit remains, as of these facts, an accused party in a civil complaint, not a defendant found liable by any court. The earlier case, involving different allegations about the glass business and car wash retention, ended in a settlement with no admission of wrongdoing from anyone involved. What is confirmed without dispute is narrower and in some ways more damning than any verdict. The company's own audit committee concluded that years of its own reported numbers could not be trusted, and said so, publicly, before any court required it to. Disclaimer: this program does not allege that any named individual committed a crime or is guilty of any civil wrongdoing. All executives referenced in connection with the 2026 shareholder class action are accused parties in a civil complaint that had not been resolved on the merits at the time these facts were compiled. None had been found liable by any court. The earlier, separate shareholder litigation covering the period from October 2021 to August 2023 was resolved through a monetary settlement in which the company and the named former executives expressly denied all allegations of wrongdoing. Nothing in this program should be understood as a finding of fact, fraud, or criminal conduct by any person or entity discussed.